Why are Basel Accords so complex for financial regulation? Have you ever wondered why the Basel Accords seem so complicated when it comes to financial regulation? Let's break it down in a way that makes sense. The Basel Accords are international guidelines created to help regulate banks and ensure they operate safely. They have evolved over many years to keep up with the changing world of finance. The Basel Committee on Banking Supervision, formed in 1974, developed these frameworks after major banking failures highlighted weaknesses in oversight. The first version, known as Basel I, came out in 1988. It set a simple rule: banks needed to hold capital equal to at least 8% of their risk-weighted assets. This was a straightforward way to protect against credit risks. However, as financial markets grew more complex, regulators realized that Basel I was not enough. In 2004, Basel II was introduced. This version added more layers, introducing three main pillars: minimum capital requirements, supervisory review, and market discipline through disclosure. It allowed banks to use their own internal models to assess risks, which required detailed data and complex calculations. This made the rules more tailored but also more difficult to navigate. Then came Basel III, developed after the financial crisis of 2008. This version aimed to strengthen banks even further. It introduced higher quality capital requirements, liquidity standards, and leverage ratios. Basel III also focused on reducing the risk of crises by addressing how banks are interconnected. This added even more technical requirements and monitoring measures. The complexity of the Basel Accords also stems from the need to harmonize regulations across many countries. Each country has its own legal systems and banking structures. The Basel Committee provides guidelines, but national regulators adapt them, leading to variations in rules. This means banks must maintain detailed risk assessment systems and collect extensive data. They also need to report regularly to regulators, which can be a daunting task. Supervisors must understand these complex models to ensure banks do not underestimate risks. As financial innovation continues to evolve, the Basel framework must also adapt, adding new rules and interpretations. In the grand scheme of financial history, the Basel Accords representing an ongoing effort to learn from past crises and improve the stability of the global banking system. Their complexity reflects the realities of modern finance, where simple rules are no longer enough to address the wide array of risks banks face worldwide.